Hello, this is chapter 3 video, part 3, and the topic is depreciation. So what I'd like to do right now is to share my screen. Okay, this is a handout that I did ask you to print out, and I'd like you to write this down. This is a great handout I prepared many years ago. It really is good. It teaches you what is depreciation from an accountant's standpoint. Okay, question 1. I bought a new car for $20,000. As soon as I drove it off the lot, it depreciated $2,000. It's now a used car and worth only $18,000. Is this a proper illustration of depreciation from an accountant's point of view? No, it is not. Depreciation is about allocation, not valuation. Write that down. Depreciation is about allocation, not valuation. Depreciation has nothing to do with decreases in an asset's value. Okay, well, then what is it? How do accountants define depreciation and what's its purpose? Well, the definition of depreciation is this: depreciation is a systematic allocation of an asset's cost over several periods. Why don't you memorize that? I'm going to say it twice, and you can say it with me, and then the third time you'll close your eyes and say it. Depreciation is a systematic allocation of an asset's cost over several periods. Depreciation is a systematic allocation of an asset's cost over several periods. Close your eyes. Depreciation is a systematic allocation of an asset's cost over several periods. It's interesting. I in the old days, I used to have all my students memorize that definition, and I kind of told them if I saw them outside of the college, I might ask them. So one time, honest to goodness, I was at a movie theater. At that time, it was called Edwards, and I was waiting for my movie in the the lobby and things. A student saw me. She got really wide-eyed, and she ran into the women's bathroom because she was afraid I was going to ask her to recite the definition of depreciation. And probably I wouldn't have. Anyway, it's good. It's good if you can memorize that, just because it's something that's really important in accounting. And what is the purpose of this allocation of the assets cost over several periods? It's to match revenues with expenses. Okay, so depreciation will match the wear and tear of a truck against the revenue that the truck helps produce. When you drive a truck, you're wearing out, it's wearing out, right? Well, you need to allocate the wear and tear against the revenues, right? Because then you could get a true net income figure. If you didn't do that, you're going to overstate your revenue and your net income, right? You'll overstate your net income because you didn't account for the wear and tear of your truck. Well, how does this work? Well, by practical matter, when you do your homework on depreciation, glean 3 pieces of information: cost, salvage, and expected life. Cost, salvage, and expected life. So here I glean this information for you. This was a truck that was purchased on January 1, and we're going to use what's called the straight line method to depreciate this truck. In other words, the straight line method is the way we systematically allocate that asset's cost over several periods. Well, how do we systematically allocate the assets cost using straight line method? We use this formula: cost minus salvage divided by life is how much the depreciation would be. Okay, so let's do this. Cost of the truck, $25,000, minus salvage is $9,000. Expected life is 4 years. Now, you can say, well, what is this salvage value? Well, the thing is, salvage value is what we think we're going to get back after we sell it at the end of its useful life. So we don't want to depreciate the full 25,000. Why? Because we think we're going to get 9,000 back. Well, how much then should we systematically allocate? Well, cost minus the salvage, right? 25,000 minus the 9,000. 16,000 is what we think we're not going to recover, right? So that's what we're going to depreciate. This number is called depreciable cost. So we're going to allocate 16,000 over the expected life, which is 4 years. That happens to be $4,000 per year. Okay. Now, what does that look like over the life of this truck? Well, I have an income statement, and every year we're going to allocate to depreciation expense $4,000. So in the income statement, you're going to see depreciation expense $4,000. And the next year, depreciation expense $4,000. Next year, $4,000. Next year, $4,000. When you get done, you have allocated the full $16,000. Now, how do we get it there? Well, I wish I would have put the journal entry down here. I just didn't. But every year, we're going to do the adjusting journal entry, which is debit depreciation expense and credit accumulated depreciation. So when we debit depreciation expense every year, we're going to put $4,000 of depreciation expense in the income statement. And then notice here that every time we credit accumulated depreciation, it adds to the accumulated balance. We're accumulating our depreciation on the balance sheet. Well, let me show you how this kind of works. For long-term assets, like trucks, fixed assets, we hold the truck at its original cost, 25,000. Each year, 25,000, 25,000, 25,000. That's not like we do supplies or insurance. As our insurance policy expires, our prepaid insurance expires, the asset prepaid insurance is going to get lower every year, but not when it comes to the fixed assets like this, like a truck. Well, then how do we lower it? Because we know that it's wearing out, and how do we do it? What we do is we account for the wear and tear in this accumulated depreciation account. Accumulated depreciation is a contra asset account. It goes against the asset. So if the first year the truck cost us 25,000, but it wore out by 4,000, so we're going to take the accumulated depreciation of 4,000 and subtract it from the original 25. So now we've got a $21,000 book value. Okay. Now notice each year we're going to accumulate more depreciation, right? We're going to debit depreciation expense here, and then we're going to credit accumulated depreciation. And notice that we're going to add the next year another 4,000. So now accumulated depreciation becomes 8,000. Well, how much do we have left that hasn't been used up? 25,000 minus 8,000 is 17,000. Okay. The next year, we debit depreciation expense, credit accumulated depreciation. And so we'll have the depreciation expense in the income statement, and we're going to accumulate more depreciation on the balance sheet. We had 8,000. We're going to add another 4,000. Now that's accumulated depreciation is 12,000. What's our book value? 25,000 minus 12,000 is 13,000. Finally, the last year, we're going to do our adjusting journal entry, debit depreciation expense, credit accumulated depreciation. And of course, depreciation expense will be on the income statement. And we're going to add to our accumulated depreciation. We had 12,000. We're going to add 4,000 more. Now we're up to 16,000. Now, isn't that nice? Do you notice that number? You recognize that number? That number is our depreciable cost. So at the end of its life, we have successfully allocated the full 16,000. And does that 9,000 look familiar? Yeah, that's our salvage value. In this method, at the end, we should have $9,000 left because we think that we're going to be able to sell it and get that back. So that's how it kind of works. With that in mind, let's go ahead and answer some questions. Well, what is depreciable cost? Well, that's cost minus salvage. We know the cost is 25,000. We know the salvage value is 9,000. So the depreciable cost is 16,000, right? Okay. Matter of fact, you can see that 16,000 is up here, right? With the cost minus salvage, that's our depreciable costs, 16,000. Okay. Now, the second one is a copy job. We already seen it up there. How much should we depreciate for one full year? Well, cost minus salvage divided by life. Cost is 25,000 minus the salvage is 9,000 divided by 4. So we're going to depreciate 4,000 per year. Well, that's a copy job. Like I say, we figured that out right here, right? That's where we got that. What is accumulated depreciation at the end of 2017? Well, let's take a look. I know it's 8,000. So accumulated depreciation at the end of 2017. Here's 2017 accumulated depreciation. There it is. It's 8,000. Isn't it nice when you have the schedule, you can just pick out the numbers. It's really easy. So then what's the next thing? What is the book value at the end of 2018? Well, it's 13,000. Where do we get that? Book value 2018. Book value 2018. There it is. There's 2018. Here's the book value. So it's 13,000. What is the book value at the end of 2019? And check to see if it's equal to salvage. Well, we know it's 9,000 and it is equal to salvage, right? Let's take a look at that. The book value at 2019. Book value at 2019 is 9,000. And we know we did this right because at the end of its useful life, we still have a book value of 9,000. And the reason why we don't want to depreciate the full 25, we only want to depreciate the 16, because we think that we're going to get that 9,000 back. Okay. Okay. That's good. Let me go ahead and work on PowerPoint here. Okay, what we're going to do is we are going to record the purchase of our equipment, right? On October 1, Pioneer Advertising bought office equipment for $5,000. So debit equipment, 5,000, credit cash, 5,000. So what's that look like on the T account? Easy. Debit equipment, 5,000, and then credit or cash, 5,000. Okay, so now we have equipment of 5,000, right? But we're going to do some depreciation at the end of the month. We bought it October 1. You're going to see that it's now October 31. We need to uh, depreciate 1 month of this equipment. Okay, when we dig deep, there's 3 bits of information that you need to glean. And just by experience, guys, this is a helpful tip for you to do your homework. As if you're going to do a depreciation problem, know that you need three pieces of information: cost, life, and salvage. So when you're reading it, it's a depreciation problem. Okay, what's the cost? Oh, there it is. Put it down on the side margin or somewhere. What's the life? 10 years. Great. Put it down. Salvage, 200. Great. Put it down, because those are the 3 pieces of information that you're going to need. Okay. So let's figure out 1 month of depreciation, right? From the depreciation on the equipment from October 1 to October 31, 1 month. Well, we know the straight line method that we use the formula cost minus salvage divided by life. Okay. So the cost is 5,000. The salvage is 200. Now, this is where it gets interesting, because we want 1 month of depreciation. So we need to figure out how many months are in 10 years. Well, there's 12 months in a year. And if you do that for 10 years, that's 120 months. So what we're going to do is we're just going to figure out how much per month. And it comes out to $40. Okay. That's how much we're going to depreciate per month. So debit depreciation expense, 40. And then credit, what we call accumulated depreciation. Remember, that's a contra asset account. We don't credit the truck directly. We credit the contra asset account, accumulated depreciation. So what does that look like? Well, depreciation expense, debit 40, credit accumulated depreciation 40. Okay. So what does it look like on the balance sheet? Well, accumulated depreciation is a contra asset account. It appears just after the account it offsets, in this case, equipment. So here we have office equipment, 5,000, less accumulated depreciation, office equipment, 40, and the book value would be 5,000 minus 50 is 49.60. Okay, that's how it looks on the balance sheet, because we don't reduce the like a fixed asset like equipment directly like we do supplies and prepaid insurance. Instead, we reduce it through the contra asset account called accumulated depreciation. On the test coming up in it's going to be several weeks, I think, as I do this video, because we're going to do 3 and 4, chapters 3 and 4 before the next test. But I might ask you, what would happen if you don't do a prepaid expense adjustment, right? Well, what happens if you record the supplies, but you don't record the use of those supplies? Well, that means that the supplies account is going to be overstated, right? Because you recorded the supplies, but you didn't record that you use those supplies and the supplies expense. So assets will be overstated. And of course, you didn't record the expense. So expenses will be understated, right? So to fix that, for all the prepaid expenses, we're going to debit the expense and credit the asset. Now, I guess the only one that it doesn't kind of fit that for the prepaid expenses would be the one we just talked about for like long-term assets, the fixed assets like trucks and things like that, where we credit the contra asset account. I guess the contra asset account would still be considered an asset if it's called a contra asset. Okay, that's pretty much it for this video. I'm going to stop the share And there we go. Be on the lookout for my next video, part 4, which will be learning about the deferral unearned revenue. Okay, happy studying. Bye-bye.